with the cash payments, it's considered under the book cost. However, a provision is made for a book cost where the specific amount of provision has been made out from the profit and loss account. Exercise enables the company to gain any tax benefits. This particular method, or you can say the book cost, would be considered. I want to tell you which type of book cost may be possible. Depreciation fund, provision for taxation, unpaid amount provisions, then the amount of provision for doubtful debts, and the certain amount of provisions which consider a book cost. Replacement cost. It is a cost at which an asset or material was purchased that would replace the previous valuables. It means that they were identified that the certain machineries and plant and the fixtures were actually not in a working positions, or maybe their capacity were not appropriate as per the requirement. The company willing to take a decision wanted to change and replace of their existing plants, and at that point of time whatever the replacement cost incurred, which is considered under this head. So it is the cost of replacement at current market price. Next is avoidable cost and unavoidable cost. This cost can be avoided in future as a result from managerial choices, because the management can choose not incur them. So certain period of time what happens, the management may have an option to choose whether this cost can be incurred or not. For instance, salary paid to employee in the section can be stopped if the management wanted to terminate that employee. So if the employees are terminated, that cost would not be incurred. So that is avoidable cost. Unavoidable cost is the cost which will not be eliminated with the discontinuation of a product or the department or the particular task. So in that sense, there may be management and the top level people may not be have a control to control or and unavoid that particular cost. Like the salary to be paid to the company manager cannot be stopped even if the product is terminated. Next is differential cost. Very important. Differential cost, that is maybe incremental cost or a decremental cost, is the difference in the total cost that will change from the selection of one alternative instead of another. So it means that the one selection, the one option has been selected. Instead of that, if they were actually turned up into another selection and the cost has been changed and incurred, which is called differential cost. It involves the estimation of the impact of decision, alternatives on cost and revenues. The two basic concepts which go together with this type of cost analysis. One is incremental cost and the other one is incremental revenue. So that decremental cost and decremental revenue. If the change in the cost is in the increasing mode, it is called incremental cost. So incremental cost is if it is decreasing with the decrease of a certain output, it's a decremental cost. Incremental cost would be determined and identified when the amount of the production level has been increased from one point to another. Then whatever the difference or increase in the total cost, that is an incremental cost. And in the same case, if the production capacity has been gone down, reversed, and because of that reason, if it impacted on the total cost has been also reduced proportionately, the whatever the cost has been reduced, that is your decremental cost. So this is what all about the incremental and decremental cost. Moving to the next point, that is difference between marginal costing and differential costing. Marginal costing is, it represents the increase or decrease of the total cost which occurs with a small changes and output, where the differential cost is, it is the change, that means increase or decrease in the total cost due to the change in the level of activity because of a technology, because of the production process, or maybe the change of methods of production. So that means there is a difference. Here the increase and decrease in the total cost because of the small changes, but here the increase or decrease because of the larger scale of change. In the marginal costing, in this only variable cost changes are to be considered, but in case of an differential costing, variable as well as fixed cost also to be considered, and their changes are also to be identified at all the level of activity. In marginal costing, wholly excludes the total cost or a fixed cost. Some of the fixed cost may be taken into account as being relevant for the purpose of differential cost analysis. But in the differential costing can be made in the case of both absorption costing as well as the marginal costing would be considered. In that, the last point is marginal costing may be embedded in the accounting system where the differential costs are separately method and analytical statement. Now moving to the next point, that is types of decision making. Several types of decision making are there, like a make or buy decision, shutdown decision, that the rent or purchase, then the amount of product mix and sales mix decision, shutdown decision. So there are several types of decisions are there. Let's discuss one by one all the types. Start with this first is make or buy decision. Make or buy, it means that in case the firm is actually having an option that the company can manufacture that product in the premises, in their production department, or it can be buy or purchase from outside and other sources. It shows that in the case of that, if the certain situations are there where the company can acquire that product from outside, or that the sources are available to manufacture in the premises, it is called make or buy decision. If the firm had adequate idle capacity to make that particular part or a component or a product in the premises, would not require incurring any part of fixed cost for producing that particular components. So make or buy decisions will be taken with the help of marginal costing in the different manner. Which type of manners are there? In a situation where a firm, although capable of manufacturing, fails to actualize its production and fulfill its requirement from external sources, then the purchase plus fixed cost of manufacture to take a decision to make or buy. Another one is when the productive capability exists and it is utilized for manufacturing other products. See that here, when they have enough amount of productive capability exists, that means in the premises, it is utilized for manufacturing other products, the purchase price should be compared with the marginal cost of the product plus opportunity cost also. And one more, when there is no additional capacity in the premises, it is proposed to acquire additional facility for manufacturing, the purchase price should be compared with the marginal cost plus fixed cost likely to be incurred for manufacturing with the other facility. So this is what all about a make or buy decision. Another types of decision making is adding and dropping product line and other segments. A segment should be added only if it is increase in total contribution margin is greater than the increase in the fixed cost. That means if the total amount of contribution margin is more than the total amount of fixed cost, then the particular segment can be changed. A segment should be dropped only if the decrease in a total contribution margin is less than the decrease in a fixed cost, because of in that situation the company may not be received enough amount of profitability. Some major points to be considered for discontinuation of product, like highly competitive nature of the product would be considered under this. Value of resources released on discontinuation. So that also to be considered by these types. And the contributions, margin earned from that particular product is also considered under this method. Next is purchase or lease. While taking a decision regarding the capital investments, company and then management will have to decide for different type of options, that the whether company should purchase that assets in the premises or can be taken as a lease. So whether to purchase or a lease, that decision has to be taken by the management. To take such decision, company will compare the total cost of both alternatives and will try to know that additional amount of savings. Whichever options savings more would be comfortable are preferred. Next is shutdown cost. It is a point of operation where a firm is indifferent to continuing operations and shutting down temporarily. So that means the company has to take a decision whether they wanted to continue these operations, or that process or the continuation of the business may be incurred a certain amount of fixed cost instead of the profitability that they wanted to shut down. So the shutdown point is the combination of output and price where a firm earns enough revenue to cover its total variable cost. It means that if the company at least they reach the positions, then the variable cost and the fixed cost and contributions are remains same. But if they would be actually incurred more fixed cost than the contribution, they have to take a decision for shutting down. So shutting down is that the cost which the firm incurs when it is temporarily stops its operations. Besides fixed cost, shutdown costs include the cost of sheltering plant, equipment layoff expenses, employment and training of workers when the plant is restarted, and other part of losses of the market. So this is what the part of shutting down. Calculating the shutting down cost, one must only consider the cost that would not occur if the firm continues its operation. Important factors to be considered at that point of time, like 1. In case of shutting down the business, other companies may get the chance to establish their same type of business and products. That is the one chance. If the production is suspended, the product would be lost from the public memory, and when the business restart, it would take a heavy expenditures on marketing and advertising. Another one is, once the skilled workers are discharged, it might be difficult to get back experienced and skilled workers at the time of business resume. And this part of this, all these important tasks has to be understood before you are taking a decision of shutdown. Next type of decision making is acceptance or rejection of a foreign orders or exporting new markets. Acceptance or rejection of special orders frequently happens. Why? Because of if your product is identified, if your production capacity is more than enough to fulfill the domestic supply, after that also there would be a space that the production capacity can increase to achieve some more and more markets. So the opportunity arises for the management to consider an order for a quantity of its regular product or at a special price. When there is exercise or idle production capacity, such a situation may be attractive. So in that sense, at the time of attractive situation, idle productions and capacity is possible. If there is no idle capacity, no possibility, then the question of accepting and rejecting an order does not arise. This decision is